Good morning, everybody. Thank you so much for joining us this morning. It is 29 past, and I see that there are still a whack of people climbing into the call. So if you don't mind, we'll give it 1 or 2 more minutes before I hand over to our esteemed panel. Just a couple of house rules. We are recording the session. We will share both the recording and a copy of the slide deck with you later today or first thing tomorrow. What we will also be doing is, if we don't get to Q&A, we will compile a list of questions and answers and share those with you as well. So I think we'll give it 1 more minute and then I'll hand over. Thanks for your patience. I just realized we should have some of that special elevator music while people are entering the lobby. But I can see that we are nearly full, so we've got quite a few people already in. And I think, just in respect of everyone's time, I'm going to hand over to Yolandi Esterhazen. She got a very good introduction from Johan earlier, but basically what we need to say is that she is the Mick Jagger of compliance. So Yolandi, I don't know if I've done that justice, but Yolandi will give us a quick update on compliance, and then we'll hand over to Karen for the product updates. Thanks, everyone.
Thanks, Lucy. Good morning, everyone. Welcome to the session, and thanks for making the time to attend this session. I think we are in such interesting times, like we've never seen before, with the budget speech being postponed, etc., and it might feel uncertain. So we thought it would be good to just have a session on what to expect in terms of the changes, the update, so from a compliance perspective, and then Karen later on will just explain what to expect from a system perspective. Feel free to post your questions in the channel or in the chat, and we'll, like Lucy mentioned, and then hopefully we will be able to answer all of them. So basically there are 2 elements of tax changes, or let's say payroll changes, that would be applicable from March going forward, affecting the payroll taxes. And then it's usually announced in the budget speech, and those changes are typically your rates, your rebates, your medical tax credits, travel and subsistence, deemed rates, and then ETI brackets. And then on the other hand, we have actual legislation that goes through a whole process, and it is the Taxation Laws Amendment Act and the Tax Administration Laws Amendment Act. And that has already been promulgated, which means it's already legislation with effect from March 2025. So we know what to expect. We're prepared for that. So we thought it would be good for you to get an understanding of what will change and how it will impact the system, and also your payroll processing on a day-to-day basis. So what do you need to be aware of? Now, with the budget speech being postponed, we know that there are certain elements that we don't necessarily know exactly what to expect, and then we have some of the information already available to us. So only tomorrow, if all goes well, and we continue with the budget speech, then we'll see what the tax tables look like, and whether there will be, most probably be ETI changes in terms of the brackets, the medical tax credits. I'm not sure if there will be changes, but we'll see. And then obviously the much debated VAT changes. What we do know at this stage, and what had been published already, was the subsistence rates, the daily allowance rates, and the rate per kilometer and cost scale table. Karen, if you can please just move to the next slide. So that is usually only announced in the budget speech, but now we have it available to us. It's been gazetted, which means it is safe to apply in our system. So I'm not going to run through all the details. So for subsistence overnight allowances, meals and incidentals, the amount is now 570 Rand, and for incidental expenses only it's 176. It increased slightly for day trips where they don't sleep at the destination. For meals and incidentals, it's 176 Rand. And then, as usual, the foreign subsistence rates will be on the SARS website. And then you will see that the rate per kilometer decreased from 484 to 476. Now, this will obviously have an impact on the employees if you pay more than the prescribed rate. So now, even if you paid 484, it would be more than the current prescribed rate effective from March, which is now 476. What you need to remember is whatever you pay more than the prescribed rate, that gets put into the pay-as-you-earn net, which means the pay-as-you-earn will increase of the employee. So prepare your employees if you do pay more than the prescribed rate. Review your rates if necessary. If you need to lower it to 476 as per the SARS deemed rate, whatever the case may be, but be aware that that will have an impact on pay-as-you-earn because it's been reduced. Then you will see the cost scale table to determine travel allowances. Go and review that the amounts are still correct in terms of our travel allowances. We don't want the employee to have to pay in tax and assessment. So go and calculate a realistic travel allowance based on the cost scale table. If you don't use the cost scale table and you rather use the simplified method, then the rate per kilometer, you just have to be aware if you pay in excess of 476, there's going to be a pay-as-you-earn implication. I've added the note at the bottom or a link to the income tax notices that you can see on the SARS website, but it's basically what I've summarized here. You can move to the next slide, please, Corin. So that is in terms of the budget speech, what we know and what we don't know at this point. Hopefully we'll have answers tomorrow to everything and all the rates and everything will be finalized, seeing that we have payrolls to run. And I'm also cognizant of the fact that the deadlines are tight because I know you're running payrolls. It's going to be, the budget speech is happening quite late. So it is going to be a lot of pressure to get that ready. But Corin later on will explain what would happen when they release and what if you don't load the update ahead of time and so forth. But at least you know then what to expect in terms of legislation. So the second element that I want to touch is what we know and we've prepared for in terms of the Taxation Laws Amendment Act and the Tax Administration Laws Amendment Act. Now, the change in legislation, there are two changes which do not affect the system, but I think I want to mention it to you so that you're just aware. Remember that all the changes are explained in the release documentation, so the release notes. There's much more detail on the release notes and things that you have to be aware of. This is very limited time to explain everything and to put everything on the slide, but be sure to go and read the release notes and also keep an eye on the community hub for more information. Now, the remuneration proxy, again, you will see that will also be included in the notes that I'm going to send out, but maybe to just briefly explain what it means. The remuneration proxy definition had been clarified in the legislation itself. And basically, in the remuneration proxy, and maybe just to take it one step back, we use the remuneration proxy, which is basically the employee's remuneration of the prior year. Now, we make use of that if we need to calculate the fringe benefits. So certain fringe benefits, for example, low-cost accommodation or low-cost housing, and bursaries, for example. So those are the three main fringe benefits that we need the remuneration proxy for. But in the definition of remuneration proxy, the legislation refers to an associated institution, because we need to look at an associated institution in certain circumstances to determine the remuneration proxy, especially if it's a group of companies and the employee works amongst all the companies in that group, for example. But that put aside, so the associated institution definition then was never clearly defined in the 7th schedule, which deals with fringe benefits. So basically, the legislation was just simplified to say, look, if you calculate the fringe benefit and you use the remuneration proxy and you get to the definition and you see associated institution, you actually have to go and look at the definition of associated institution as defined in the Income Tax Act. And you shouldn't just use it in the normal sense of the word. So make use of the definition in the Act. So it's really a technical change, but just so that you're aware of and that you do apply this correctly when you calculate those fringe benefits. The second one is the extension of the learnership tax incentive. So that, as usual, it's just been extended for another 3 years to March 2027. So it would be applicable to learnership agreements entered into on or before the 1st of April 2027. So if you do claim those incentives, you can continue doing that. Next slide, please, Corin. Okay, so then the changes that relates to system changes or that you need to be aware of. And the first one is the savings spot withdrawal benefit. Now, this is not a new change, and I'm sure you're all aware that from September 2024, employees or members of a fund are allowed to withdraw from their savings spot from their retirement funds. Now, the legislation is basically now just changed to say those withdrawals are not subject to STL and UIF, which makes absolute sense. The fund pays the amount and it's not the employer. So it shouldn't be subject to STL and UIF. So that was just a system change, but we have, in most of the system, we have applied that in any case, backdating to September. And then it's important to note that it doesn't affect the employer or employer in the usual sense of the word, because it's the retirement fund that must apply for a directive from SARS to determine the pay as you earn. Remember, retirement funds are basically seen as employers in terms of the for schedule to the Income Tax Act. So they will also use a payroll system, and they need to also report against certain IRB 5 codes. So the fund will then report the savings spot withdrawal benefit against code 3926, and there will be no STL and UIF, because we don't want that also to be seen as a UIF contribution, which then messes with the fund's calculation of benefits. So that has already been incorporated, just for you to be aware. Then the ETR monthly remuneration. And I have no idea why this happens. The slide keeps on cutting off that one sentence, but I'm sure, I don't know if it's the size of the screen, Corin. But I'm sure if we share the slides, it will be correct. So apologies for that last sentence, everyone, but I'll explain as possible. I see this spacing is just not 100%. So with ETR monthly remuneration, so the monthly remuneration definition has now also been clarified in the legislation, and I'll get to the definition just now. The legislation was changed just to clarify it, but our systems have already provided for the correct application since March 2022, because March 2022, we confirmed the correct application. So we've already provided for that and changed our systems from March 2022. But with the legislation now being just clarified, just put it in the system changes so you go and that you're aware of the change, again, the clarification. Thanks, Corin. And that you also ensure the system is set up correctly. Now, the ETR remuneration, for the purpose of calculating ETR, remember the brackets of ETI, if the employee earns within a certain bracket, then there's a calculation that should happen according to that bracket. Let's say 0 to 2,000 Rand remuneration, then there's a calculation. The next bracket to 4,000, roughly, there's a calculation for ETI. So depending on the brackets and whether you're in the first 12 or the second 12 months of employment, the ETI should calculate accordingly. But the remuneration that must be used to determine the bracket that the employee is in for the purpose of determining ETI is very clear. So it's remuneration. It doesn't include non-cash benefits. So in other words, if there are fringe benefits, it doesn't get included in my remuneration to calculate ETI. And then we have to reduce the remuneration with deductions not allowed as per the BCA, more specifically Section 341B of the BCA. So what it basically means, if you go and calculate remuneration, okay, firstly, we don't consider fringe benefits. why would we have to reduce the ETI remuneration to calculate ETI? And the reason for that is National Treasury picked up on training schemes or schemes where the employer will pay a training institution an amount to train an employee. They will reflect it in the payrolls as being an employee, where they pay a salary, for example, a remuneration or a stipend, whatever you want to call it. And they would also deduct the training cost, and that they will pay over to the training institution. And this employer will then claim ETI, but they've never actually, in essence, employed this employee. They've just paid for someone to be trained by a training institution. And that is what National Treasury wanted to avoid, for employers not to claim ETI where it's not really an employment-employee relationship. So what they tried to do with changing the legislation, to say, if you do have ETI remuneration, and obviously there are other measures in place too, but we focus on the remuneration. If you do pay remuneration, but you have a deduction, so you subtract money from or an amount from that employee that is not in line with the BCA, then it should reduce your ETI remuneration. I'm going to use an example. I pay the employee, I'm going to use 6,500. I know with 6,500, the ETI remuneration is or ETI amount is theoretically basically zero, but let's try that. So I pay the employee 6,500, but I deduct 6,500 and I pay it over to the training institution. So the remuneration would theoretically be 6,500. If I go and deduct 6,500, then because I'm reducing it, because the BCA doesn't allow for the training costs necessary to be deducted from the employee. So if I deduct it, my ETI remuneration gets reduced with whatever I deduct that's not in line with the law. So 6,500 minus 6,500 gets to zero. So the ETI remuneration will then be zero, and there won't be any ETI. Okay, so just for example, I didn't take into consideration the actual brackets and the fact that 6,500 is basically zero, but that's what they wanted to avoid. They don't want, so they want you to reduce your ETI remuneration, even if there are other deductions, even if you only deduct, let's say 3,000 Rand for training costs, it must reduce the ETI remuneration. This doesn't just apply to training cost, but this was the intention of the change, to make sure that the training cost isn't carried by the employee, it's carried by the employer, and that the employer doesn't claim ETI if they don't physically actually just employ the employee. So to get back into summarize, so the ETI remuneration would be your cash, basically, cash remuneration, so no fringe benefits, and it must be reduced with deductions that is not allowed in terms of the BCA, section 34(1)(b) to be specific. And the reason why I'm mentioning this again, although our systems are providing for this since March 2022, is I need you to go and double check your systems, because maybe it wasn't checked in March 2022, and now there will be penalties, very large penalties if we don't apply this correctly. So go and double check that the system is set up correctly. And remember that the systems are not able to identify which deductions are in terms of legislation and which not. Yes, there are certain deductions, for example, pay as you earn. We know it's in terms of law that it must be deducted. UIF, it's in terms of law. So there are certain deductions that is also reported against an RB5 code that the system can pick up as a legit BCA deduction, if I can put it that way. But then other deductions do not get reported against specific RB5 codes. For example, you can have a birthday fund, or you could have a union deduction. So the systems aren't able to identify those. It doesn't get reported on the RB5. So it would be your responsibility to go and indicate which deductions are not allowed in terms of the BCA, so that it can reduce the ETI remuneration and the ETR remuneration is calculated correctly. So I would encourage you just to go and double check your systems or reach out to your partners if you're not certain, but please do that to make sure that the ETR is calculated correctly. You can move to the next slide, please, Karen. And while you're busy checking the deductions, not in terms of the PC8. Oh, and again, refer back to your notes from March 2022. If you're uncertain, we've explained it in detail then. So you're welcome to refer back. Same applies. If you're busy, and now this is Murphy, it's printing, go and check that your fringe benefits are excluded. So the non-cash payments should not be included in ETR remuneration. Now, the systems are able to exclude fringe benefits because fringe benefits are reported against a certain IRB5 code. So the system is able to pick up on against those IRB5 codes and exclude that from the actual calculation. But certain codes are used for cash and non-cash payments. For example, a travel allowance is reported against code 3701. That is included in ETR remuneration. But if it's a petrol card is also reflected against code 3701, but it's non-cash. So go and make sure that you have excluded the petrol card. And again, it was explained in the notes and on the community hub in 2022 how to exclude. But reach out to your partners or the support teams if you're not sure how to exclude that, but please go and double check that it's set up correctly. Then some other changes, just the national minimum wage. I'm sure you've seen that it increased effective March, and it is important that you do process it correctly as it also affects ETI. So the wage check, so to determine whether somebody qualifies for ETI or not, it checks whether you pay the national minimum wage at least. And obviously there are exemptions and other rules, but for the majority, you need to pay at least the minimum wage per hour. So if you do process, please process the national minimum wage rates correctly for the system to be able to do the correct checks. And then I think the most important one for today that I want you to be aware of, and again, this will be explained in detail in the release notes and on the community hub. If we get more information, we'll share that too. But this is quite important. So from March 2025, there will be a new tax deduction for refunds or repayments to employees. You can move to the next slide, please, Corinne. A tax deduction is basically, and if I can just recap, a tax deduction reduces your remuneration to get to a balance of remuneration amount on which pay-as-you earn and STL is calculated. If I can give you an example, if I have a salary of 20,000, theoretically, I'm supposed to be taxed on 20,000. But if I do contribute towards a retirement fund, let's say I pay 2,000, then the 2,000 is subtracted from the 20,000 to calculate my balance of remuneration. So 20,000 minus the 2,000 gets to 18,000. So 18,000 is then my balance of remuneration on which I will be taxed on. So it reduces the amount on which my pay-as-you earn and my STL is then calculated. Currently, we have two tax deductions. We have tax deductions for retirement funds. So if I contribute towards a retirement fund, there's a tax deduction. So I get a tax benefit basically, and then donations. If I do donate to specific charitable institutions, then I can also claim a tax deduction on the payroll. Now, the legislation basically introduced, with effect from the 1st of March, it introduced a third tax deduction, and that is where the employee needs to refund or repay an amount that had previously been included in the remuneration of the taxable income of the employee. Examples of this will be, let's say, where I went on maternity leave, the company said they will pay me a salary for, let's say, 3 months or 4 months, and when I return, I need to work at least another year for the company before I'm able to resign. If I leave before the end of that year or 12 months, then I need to repay let's say either the full amount or portion of the salary that I received while maternity leave. Another example would be if I get a retention bonus to be employed still by the company for, let's say, 24 months. I'm just using an example, but then I resign beforehand and I need to repay the retention bonus. Another example would be for commission earners, especially in the insurance industry, where they need to repay commission to the employer if the policy lapses. So these are the types of examples where it was correctly included in the tax calculation of an employee, so in taxable income or the remuneration of the employee, but needs to subsequently be refunded or repaid to the employer. Now, up until now, what had basically happened was if the employee repaid the amount, the employer would have given the employee a letter stating that they've paid the full amount or an amount, and the employee would then claim that deduction. It's called a Section 11NA deduction on assessment. But for the employee to wait until assessment, could have had a negative impact on cash flow, etc. So instead of waiting until assessment, the legislation now provides for the tax deduction to be allowed on the payroll. So as soon as the employee repays, they don't have to wait until assessment. The employer can just provide them with the tax benefit, so to reduce their taxable income on the payroll, and it basically reverses, so you get the tax benefit at the end of the day. Now, the tax deduction will be limited to the remuneration for the months during which the refund is deducted. So I'll get you an example just now, but it's basically where the employee's remuneration, let's say my salary again is 20,000, and I need to repay a retention bonus that I received in the previous year, and it could be the same or the prior year, of, let's say, 30,000. Now, there is not enough remuneration. So my remuneration is 20,000. I need to repay 30,000. So the tax deduction should be capped to the remuneration for that month. So the 20,000. So if I get a tax benefit of 20,000, there will be an excess of 10,000, and that can be carried forward to the next month, so that I can get the tax benefit of the 10,000, so the excess in the next month, if it falls within the same year of assessment still as the refund. Now, at this point in time, it would be the employer's responsibility to manage the repayment and the subsequent tax deduction. So you'll decide how much, obviously, based on the contract, the employee needs to repay. And it could either be on the payroll, or it could be a bank-to-bank transfer. But if the employee is still employed, then they are allowed to get this tax deduction on the payroll then. So you need to manage this at this point. And then, to be honest, there are actually quite a few areas or that we, on certain aspects that we are clarifying with SARS. So we need clarity on certain elements, for example, the IRP5 code and the application of this deduction. There are a few outstanding issues or aspects, and we're working closely with SARS as part of the Payroll Authors Group of South Africa to finalize those requirements and, and the legislation. We'll see if amendments need to be made, then we'll propose amendments. But for now, so there is a bit of uncertainty around certain aspects, but please do keep an eye on the channels, the community hub, on our on the release notes, and as the more information that we have available to us, then we'll share it as soon as matters are cleared up. And then at this point, it's our understanding that it's not applicable to administrative errors. So in other words, we have paid overtime in error to someone, and the employee repays me. So I reversed that payment. It wouldn't necessarily be included in as a tax deduction. So at this point, it must still be confirmed. But at this point, it's our understanding that it doesn't apply to administrative errors, but rather to scenarios that I've explained where there's a breach of an end contract and so forth. So where it was correctly included in my remuneration, but needs to be refunded subsequently. Can move to the next slide, please, Caro. And then to just show an example what the impact will be. An employee received a retention bonus of 3,000 with the condition of completing an additional year of service. However, the employee then resigns during the next tax year, and the final month of employment is then in April. And as a result, the employee will have to repay the 3,000 Rand retention bonus they received in the prior year. Remember, I said the repayment can be in the same or different year. So, for example, I can get a deduction for an amount that I received in the previous tax year, or it could be in the same. Maybe I received the retention bonus in March and I resign in April, then the same applies. So whether it's in a different or same tax year doesn't matter. So in March, my salary is 20,000. It's unaffected. And you'll see there's no retention bonus showing in this year, not in March, April, because I didn't receive a retention bonus. I received it in the previous year, and that would have been applied and reported in the previous year. And then, so it's just the repayment and the tax deduction that we should report in this year. So in April, I get this tax benefit because in April, I tell the employer to simply just deduct it from my salary, for example. My salary is not reduced. There's no retention bonus that can be reduced. So my April salary is still 20,000, but now because I've repaid this 3,000, I can also get it as a tax deduction. What impact does it have? You'll see I've indicated the remuneration for the month. So remuneration is still 20,000. If I deduct my 3,000 tax deduction, then I calculate my balance of remuneration. So balance of remuneration is calculated by basically considering all my tax deductions. And balance of remuneration is what my STL, my UIF will be calculated on. And you can see then my year-to-date balance of remuneration is now being reduced to 37,000, which is basically March is 20,000, and then April's 20,000, the 40,000 minus my tax deduction, which is 3,000. So I will only be taxed on 37,000. My STL will be calculated on 37,000. Note that your UIF and ETI and your allowable deduction for retirement funds are not calculated on balance of remuneration. So the 37,000, that is calculated on the remuneration. So the 20,000 Rand for April that you received. So your UIF contribution will not be decreased. It will still be based on your remuneration. Now, I know in some instances, employers might have reduced the amounts against the relevant RB5 code. For example, let's say I'm going to go back to my example that I used where, let's say I received a retention bonus in March of 3,000, and then in April I need to repay the 3,000. Some employers have simply just reduced, let's say go 3,605 with 3,000 Rand, which would have adjusted my pay as you earn. It would also have had an impact on my UIF and ETI and all of it because you're reducing your actual remuneration. But from March, the correct way, and I'm not saying that was wrong or right at this point, but the correct way from March is not to adjust your remuneration, but you have to, it's just a tax deduction in which will basically reduce the balance of remuneration. So your pay as you earn and your STL will be calculated then on the reduced amount. Now, I've indicated code 4042 as being the IRB5 code that SARS confirmed it must be used for this deduction, but I've marked it in red because SARS still needs to clarify whether they want the actual repayment of the employee to be reported against that code, or whether they want just the portion that was considered for pay-as-you-earn purposes. So the tax deduction part, which was considered. So we'll keep you posted on that, but just be aware of that. And then obviously it's a very short of time or short amount of time to run through all possible examples and explain this in detail, etc. But you're welcome to attend the annual payroll tax webinar that Rob Cooper is presenting. He goes into detail about all the changes, not only these other relevant changes too, in-depth calculations, if you need more information. And again, if you have more questions, you're welcome to pop it in the chat. But I hope that this is making sense. And again, keep an eye on the release notes because we go into more detail as to the result of this and the impact on other payroll elements. And then I think that's it from me, Karen.
Yolandi, I see there's a hand raised. So we quickly take Christelle's question, and then from there we can move on.
I'm just worried, will you not run out of time, Karen?
I'll speak quickly.
Unless we leave the questions to last. Christelle, will that be okay if we just continue? So, Karen, because
I think I'm going to continue
over
then.
my time, and then we'll take the questions at the end, if that's okay with you, Christelle.
Yeah. I'll just pop it in the chat in any case. If we don't have time for the questions, we will answer what's in the chat. We will answer that for you in a formal way, get everything ready. So I've seen one of the questions in the chat is, when do I get the update or the release? So basically, with the budget speech on tomorrow, I want to put it in red out there, depending on the content of the budget speech. We are going to aim to have it with you between the 17th and the 19th of March in that time frame. And having said that, I want to urge you to please register for us on the Sage Community Hub. That is the quickest, fastest way that we can get communication to you, faster even than an email, because an email need to go through approval process. Everybody needs to say they're happy. We're on the Community Hub, we just put the post there. So the moment the software is available, we can put it on the Community Hub for you to say it's out there now. You will still receive emails. We will do the normal update communication, but for those that's in a hurry, that's the best place to go. What will be there for our Premier and Classic and Payroll Professional customers? It will be a release 6.4a payroll release. Then for our Premier customers specifically, there will also be a Premier HR and a Premier ESS release that you need to install. So just take note of that. We will communicate that further on. Just for the reference, if I speak about Premier only, it includes our classic customers as well. It's just making it easier for me just to speak about the one word, but take note, Classic is included. Where it's separate on the products, because we've got all of you in the same session, I will make mention separately. It's important that you install the update before your May payroll. You cannot roll over from April to May. Obviously, the best is to install it in March, if it's possible. It all depends on when you need to pay. For our Premier and Classic users, just a note to take, if you run the installation, please run it with full administrator rights. Run the installation on a server, and take note that each user that log into the payroll after the update will have to have administrator rights just for that initial login. After that, the administrator rights can be removed again. This is normal update procedures. I just want to reiterate it for you. For our Payroll Professional customers, obviously it's much easier. You will log in and there will be a notice saying your update is available, and you can then just click for us to update your companies. So your process is much easier. Then just further information that's important to take note of. The update will recalculate your tax liability to the beginning of the tax year based on the budget requirements. Normally, that's how we work. It's from the 1st of March. We don't know if it's going to work the same. With regards to the travel reimbursement rate, that change that Yolandi mentioned from the 484 to 476, please hold back on capturing your travel transactions until you've installed the update. If you have captured your transactions before installing the update, you will have to delete them and recapture them again. So we recommend that you wait with your travel transactions until you receive your new software. What you can do while waiting for the release, make sure you've got your tax year-end copies ready, make backups, roll over to your March payroll. You can do your normal processing, except for that travel reimbursements. If you need to load new employees, if you need to load overtime, you can do all of that. You just hold back on the actual payments until you've installed the new tax update. Then important, please check your minimum wage codes for ETI. Like Yolandi said, there was changes on the minimum wage for ETI. We see a lot of audits on ETI, so make sure that your ETI is correct. And then for our Namibia customers, I will elaborate a little bit on that later on, but your social security limits changed beginning of March, so you can also start with that. And this is just quickly to show our Namibia customers. The update will default the new new rates for your Namibia Social Security, but you don't have to wait for that. You can go in the interim and change your monthly lower limit and change your monthly upper limit to the new values. You don't have to wait until the update is installed. Once you've done that, the system will ask you if you want to do a recalculation. You can please answer yes, and it will update your social security for you. So it's something that you can do before the update gets delivered to you so that you're prepared. That's on the compliance changes. Then just a little bit of software changes that we made based on information we receive from you as our customers. It normally comes, a lot of them come to us on our user feedback email, or it comes to us on questions that our business partner poses to us. So the first one there is the UI 19 change. In the past, we created a UI 19 certificate and a summary report. And what we realized is that the Department of Labor is actually requiring a salary schedule report that show the last 4 increases of an employee. And then also the other thing that we realized is that our summary report printed multiple employees on one page, making it difficult if you want to hand that out to the employees. So just to take you through what's changed there so you can quickly see. First of all, the screen selection changed, print time selections. You can select terminations or UIF employment status, or you can select both. And then we just clarified for you, if you select terminations, who will be included? If you select the UIF status, who will be included in that selection? Then on the next screen, the third question, the print time selection screen used to have a column labeled termination or maternity, but as we are including more employees there now, or more statuses, we've just changed, sorry, I'm struggling on my English words, we've just changed the status of the heading to say status and not termination or maternity anymore. And this is just to show you an example of the report. In your release notes, there's detail about each field and where we read it from. So in other words, if it says surname and initials of the applicant, which fields in your payroll product are we reading to print on this page? And this is then where you can see the salary of the past 4 increases that the person received. So yes, also take note that we changed slightly on the naming conventions of the files. So you can see the company number, the employee number, and the employee surname as a PDF. So it makes it easier just to realize who you're working with when you look at it. Then also just to show you the summary report. When you print it now, it is going to print one person on a page or one individual so that you can actually hand this out to the individual employees when they leave, when they need to take it with them. This is just to show you the naming conventions. In this case, I worked with an employee called with the surname Miller. There's a summary and a salary scheduled that created in a zip file. So we hope that would make your life a bit easier. We know that we always need to make plans to get things easier on your side. Then for our Africa countries, there was a huge lot of changes since September last year with our previous update. Eswatini, Swaziland, Ghana, Angola, Nigeria, Zambia, Kenya, a lot of them. Zimbabwe, Kenya reports, bank file changes. All the changes has been released and were shared on the community hub as well as on the downloads page. But with the release that you're going to install now, if you missed something somewhere, it will be included in the release that's going out now. So you can just maybe just be aware of that. Then there were a few items that were resolved or that were implemented. There's a lot of them in the release notes. I'm going to highlight some of them that I just want to make you aware of. .b batches, there was a problem if you captured a value of 10,000, then the first digit cut off. That's been resolved. Okay, I must just say cut off on the report, not on the actual input. Then we've made a change for the customers using our skills module. There was a change on the Mercieta report and the Cheetah reports, so you can maybe take note of that. There was customers using our Sage self-service module. On the report, when you synchronize your transactions or you upload your employees, there was a heading where it said error, and it's not always an error. In some instances, the employee did not upload because he opted not to be uploaded. So the reason the employee did not upload is now the heading, and we hope that would make it clearer so that you don't get a fright when you see error. Then customers licensed for the leave module when entering planned transactions. The date defaulted or displayed nines only. The transaction was correct when it entered, but the display didn't look right, so we resolved that. Then on RSA customers, your OID report, if you did employee transfers without year-to-date figures, the system used the date engaged and not the RP5 start date. So we've rectified that so that the RP5 start date would now be used for transfers of employees without year-to-date figures. Then payroll professional changes. This is only on the payroll professional product, which works slightly different. On the 12-month history report, if you selected to print bank account numbers, it did not print the employee fixed info section, was not printing any information on the details tab. So that's been corrected. Then if you on the backup side of things, the first one, on the on-demand backups, we've removed the log file. The log file records all transactions, all entries. It's an audit trail file, and it's a very big file. So when you make an on-demand backup, for example, just before you do a batch update, that big file will not be included in that backup. But your normal bigger updates or backups will still include it. Then also on Payroll Professional, when you select that you want to update all your companies, there's a little tick box that says create a backup before running those updates. We are now by default going to tick that box for you, basically just because we are in a period where we see load shedding going on and off again, and we see dips in connection. So we just want to make 100% sure that we've got backups when you run that update. You are, however, welcome to untick it. It's there. We just changed the default because we think it's safer to have it ticked. And then also on the Payroll Professional product, in product message, we've just changed slightly there to the link where it's taking you. So that was very quick. Then specifically for our Premier and Classic customers, we are implementing Sage ID, or then Sage, also known as the Sage account. So each Premier and Classic user accessing their South Africa company in the 25-26 tax year must sign in using a Sage account. We create a link between that Sage account, or then the Sage user, and the payroll company. You will have 30 days to do that. After the 30-day period, you will not have access to your payroll companies if you haven't signed in with the Sage account. The Sage account only needs to be entered once per year, but you unfortunately have to enter it for each company. So very important, the sooner you enter that Sage email address to link your email address or your Sage account to your company, the better. It, else it's going to be frustrating seeing the message every time. Okay, so just to elaborate a little bit further on that, two-factor authentication is not required for Premier and Pastel customers. It's only if you opted on this Community Hub to activate the two-factor authentication that you will see it on Premier as well. So the question is now, how do I create that Sage account and what will I see? This is what you're going to see. When you click on your company to access, a message will pop up, and this message will tell you, connect this company to your Sage account, create a secure digital identity for your Sage products and services. Access all your connections with a single secure sign-in, and you can postpone the message for 30 days. After final reminder, you will no longer be able to access. So when you click on that continue option, you will see the block at the top, very familiar to all of you, I'm sure. You enter your email address there. If your email address does not exist on the Sage account database currently, if that email address that you've entered is new, then if you click continue, it would ask you to enter your email address, your name, your surname, and select the password. And that's it. Continue, you're done. If you already have signed up to the Sage Community Hub or to the knowledge base or to training where you use your Sage ID or your Sage account, you literally just enter your email address and you click continue, and that's it. We do, however, know a lot of our customers just click the cross at the top and they close at this message. And if you do that, you will get a message to say your Sage ID login is still pending and you need to complete it before, in that 30-day period. So the red message at the bottom is a big ask from my side. The sooner you do it, the less the frustration. I know you've got a lot of companies. Some of you really have many companies. Quickly enter that email address, get it over and done, and it's out of your way. Else it's really going to irritate you if it asks every time. This is just to show you there's a countdown on the messages, so you will get an indication there's 26 days left, there's 1 day left, or then if there's no days left, you click on continue, it will take you to that sign up. Keep in mind, the Sage ID that I'm explaining here is only for the Premier customers and the Classic customers. Our Payroll Professional customers are already using Sage ID. For them, it's their method of accessing their companies. So they don't have to do this. That is the way that they access their data. But for Premier and Classic, you still have another password that you need to enter. Okay, so just some technical information around it. It's only for your South African companies that we're going to ask it. We save that link for the company and your email address. We save that in a database on your machine. Information for all users are written to that database. For customers that signed up for employment verification, nothing will change. Everything will remain as is. For our customers that don't have employment verification, we are not sending your information anywhere. We just want to link your companies to your Sage account. Your Sage account token is saved in your registry. The reason why I'm mentioning that is if you move to a new computer, you will unfortunately have to redo this because the information is saved on your computer registry. And then it is strongly recommended that each user create their own Sage ID. So try not to share. We prefer that each user use their own because we want to expand on the functionality that we offer you with the Sage account or the Sage ID then in future so that you can utilize it better. Okay, so that was my story. I am going to have a quick look at some of the questions. Lucy, I'm not sure if you can help with some of them.
Yeah, absolutely. I'm going to start from the top. Some have been asked and answered.
Yes, I just want to say thanks to Cecilia who helped. I did ask her to come and help. She's our QC manager, and I know she's helped. And thanks for Francois Brandt. He's from our steer side. I know he also assisted with a lot of the questions. I asked him to have a look as well.
Perfect. So I'm just going to run through 2 or 3 because I am cognizant of time. So with the savings pot withdrawal benefit, nothing needs to be done in the payroll system. Is that correct?
Correct, Lucy. Nothing has to be done. I did confirm that in the chat too.
Did you? I missed that. Thank you. There are many, many questions. ETI remuneration, that's been asked and answered. The tax deduction for refunds to employers include things like traffic fines that drivers have to pay.
No. So thanks. It's a good question. So that refund tax deduction would be for something that was included in your taxable income. You would tax on it correctly, and then you repay the amount. So then you basically have to reverse that pay as you earn effect. So then you get the tax benefit because you were taxed on it. You wouldn't have been taxed on a traffic fine. It's just normal deduction from the employee's salary. So reducing your net salary. So if that is your question, whether you get a tax refund for that too or tax deduction, no, you don't. Hope that answers the question.
Perfect. Thank you. I've got another one here. We have rolled to March for our weekly payroll where we have processed week 1 already. How will this update affect the processed weeks?
So my answer there will be is that we will calculate backwards. So we will recalculate the first week's values. But I would like to say, please keep your eye on the community hub because we need to see what SARS is telling us with the budget being late. So previous years where we know it's applicable from 1 March, we would recalculate, even if you're in week 2 or week 3, we would recalculate the values for March. But we need to first see what SARS says. They maybe pop something like the new tables or new changes is applicable 1 April, and then it's totally different. So yeah, for safety, I would refer you to keep your eyes on the community hub. But further from that, it's only if you've processed travel reimbursement transactions in those first weeks. But normally we don't find that so often on a weekly payroll. That I would say, yeah, I think the weeklies would be okay.
Perfect. Thanks, Karen. There's one here. We are on Premier 6.3A plus. Do we have to update to 6.3B before we update to 6.4A?
No, you can be on either 6.3A or 6.3B before going to 6.4A.
Perfect. Thank you. There have been some amazing answers here. Sorry, here's one. Hi, what do we do if our payroll is the 15th of the month? If the update is not ready by then, do we apply all changes from April? So I think you might have answered this actually, Karen, but if you can just clarify.
You can either apply all changes in April or you can decide that you run a separate payroll run in the same month. So you process your March payroll, you pay it out, get your new tax tables, run a recalculation, and then maybe produce a second payslip run in that same month, in which case I would recommend that you reach out to your business partner if you decide to do that. If not, if you want to go over to April, it's only if you've got that reimbursive transactions that I would say reach out to us so that we assist you with the reimbursive travel transactions.
Brilliant. Thanks, Karen. Celia, you are answering faster than I'm reading, so thank you so much. But there's one here. Do we have to make a copy system before rolling over to March, even if we did not receive the update?
So my answer would be yes, because your March, your February, your copy system for February, let me just rephrase. If you look speaking about your copy system for your tax year end of February, yes, you can make that now already because you can submit your RP5 from release 6.3A or 6.3B. If you make a copy system every month, which I'm not sure if you're doing that, I would hold on till I've got the update before I do that. So I wouldn't make a copy system in March before I've installed the update. I'll wait for the update. But for your tax year end, definitely you can make that copy system.
Brilliant. Thanks, Karen. I think I'm going to just do one more here. Just very quickly, Daniel, to answer your question, we're aiming for between the 17th and the 19th for the update, just depending on the changes that come out tomorrow. And then there's a question here from Lindy. Are you able to print a U19 from the old Essential system?
Lindy, I'm going to come back to you, but my answer would be yes. I would expect that you can do it.
Perfect. So anything that we haven't got
sorry,
to here. Yeah.
Lucy,
Go
I want
ahead.
to ask one question. If you say the old Essential system, there's not customers out there using Essential still. They're all on Classic at the moment. So, Lindy, if you don't mind, just pop your detail for me in the chat. I'll pick it up there and I'll reach out to you so that I can just follow up. Because if it's on an old release that you are working with that on, is that still on Essentials, then my answer is going to be no.
Brilliant. Thanks, Karen. There are a couple of others that I think we're not going to have time to get to, but I will compile a list of all the questions that have been asked and answered here anyway. And we'll share that out with everyone when we share the recording and the slides. So I think from this side of things, Yolandi, Yolandi and Karen, we are good to go. Thank you.
Thanks a lot, Lucy. Thanks for all your help and
Thanks,
assistance
Lucy.
today. Thanks everybody for attending. It was great having all of you on the call, and we really appreciate you as our customers. All the best for the budget speech and the changes to come.
Thanks, everyone. And I see there are a couple of hands coming with more questions. The chat will be open for another 30 minutes. So please just pop your questions in there. We are out of time. But yeah, very grateful that you've joined us. And as Karen says, good luck tomorrow, everybody. Hope you've got strong tea or strong gin at your tables at 2 p.m. But thanks a lot for joining us, everyone. Cheers.